Hello and welcome to the third video for Chapter 9. I'd like to start on page 9.8 with you. On 9.8 they talk about estimated payments, and this section is extremely important, alright, especially for people that are self-employed. In 1943 the IRS developed a pay-as-you-go system because they couldn't wait till the end of the year for everybody to make their income tax payments. All right, it's no different than you and I waiting till the end of the year to get paid on our jobs. Okay, so that's when we started withholding from your paycheck. Well, when you're self-employed, you cannot give yourself a paycheck as a sole proprietor. You can't give yourself a W-2. If you need money, you just take money out of the bank. All right. So how do you pay your taxes? Right. Well, what you do is you the first year it's pretty much a guess, because you have to guess your gross income and then take that amount times what you think your tax bracket's going to be, 10%, 15%, and so on. And then you would also take that gross income, subtract your, you should take your net income, not your gross income, and take your net income times 7.65% for your FICA tax. Now the problem is, of course, being self-employed, is that you are both the employer and the employee. So that 7.65% that you pay for FICA, all right, we'll talk about that in a second, has to be doubled. All right. So, what I usually tell small business sole proprietors is this, because they're always asking, well, Rob, what should I put in the bank? And I tell them, well, okay, if you try to figure out your net income off the job, all right, whatever the job is, and then take 1/3 of that and put it in a savings account. All right, because at the end of the year, by the time you get done paying your federal income tax and your FICA tax and your Indiana state income tax and your county tax, it's usually going to be about 33%. So you should take roughly 1/3 of the net amount you make on a job after your expenses, all right, and put that in a savings account and let it earn interest all year. Okay, and then you will use that money to pay your taxes with. Now, how often do you have to pay them? All right, well, it tells you on page 9.8 near the bottom that estimated tax payments are made 4 times a year. The first payment is made by April 15th, the second one by June 15th, the third one by September 15th, and the last one by January 15th for the prior year. Okay, those are the due dates of the estimated tax payments. Okay, so how do you know what to pay? Well, again, the first year you just got to make a guess. All right, the second year and subsequent years they use usually a pretty basic rule. What they say is that you should pay at least 100% of the prior year's federal tax amount liability. All right, federal tax liability, that would include your federal income tax and your FICA tax. So you would pay 100% of the prior year, or 90% of the current year, the year you're in, whichever is smaller. Most companies can't do the 90% rule because it's hard to estimate what their income's going to be, especially really small business owners, because sometimes they don't know when their next job's going to be. All right, and so what I tell them, I just say, okay, let's take a look at your federal tax liability. All right, so let's go back to your page X in your book. So I'm going to go there. All right, and I'm going to go to page actually XI in your book. All right, and then I'm going to look at line 63. All right, line 63 is your total tax for the year. That includes your federal income tax, and it also includes your self-employment tax if you are a sole proprietor or a partner in a general partnership. All right, and the self-employment tax is on line 57. So the combination's on line 63. All right, so what you would do is you'd look at line 63 and simply divide it by 4. All right, with 1/4 being due on April 15th, the second one on June 15th, the third one September 15th, and the fourth one on January 15th of, in our case, 2019. Of course, if the 15th falls on a Saturday, a Sunday, or a legal holiday, all right, then you always go out to the next business day for the due date. Okay? A lot of times what small business owners will do is they're like, well, boy, I can't come up with that payment on April 15th. Can I just use my refund from my tax return, which was due on April 15th? Could they just use the refund from that tax return and apply it to their next year's estimated tax? Okay, and if you actually look at Form 1040 on page 2, that line is actually on there. All right, so in other words, you would apply your 2017 tax refund to your 2018 estimated taxes. Okay, now generally you don't have to pay estimated taxes if your tax liability at the end of the year was $1,000 or less. Okay, you don't really have to worry about it. All right, but if your taxes are up there around $10,000 a year, as they are for several sole proprietors that I do, then you're talking about some serious cash. All right, and the problem with that is as I mentioned at the start of this, we are on a pay-as-you-go system. So if you do not pay your taxes by their due dates, all right, the 4 due dates that I just mentioned, all right, you are subject to an underpayment penalty. All right, so I get a lot of small sole proprietors that can't make the April 15th payment, so what they'll do is they'll double up and pay both the April payment and the June payment by June 15th. That's nice, but it isn't going to stop the penalty for the first underpayment. All right, the IRS doesn't give you credit for overpayments, but they will penalize you if you have an underpayment of any quarter. All right, so what exactly are you paying? Well, you are making a payment of your estimated federal income tax. Okay, all right, and you are also making a payment of your FICA tax. All right, the FICA tax is on page 910. All right, and the FICA tax consists of 2 taxes, a Social Security tax and a Medicare tax. All right, the Social Security tax, all right, is assessed on the first $127,200 of wages or self-employment income in 2017. All right, that amount is indexed to inflation. So in 2018, that amount becomes $128,400. All right, the FICA tax is paid on that amount. All right, whether or not it was self-employment income or wage income. If you have both wage income and self-employment income, all right, you would stop paying FICA tax or stop paying Social Security tax when the combination of your wages and your self-employment net earnings equals the taxable wage base, which again for 2017 was $127,200. All right, so you have a 6.2% employee tax for Social Security, all right, which you as the sole proprietor must match. So the total is 12.4%. All right, so you would take your net earnings from your Schedule C or your net earnings from your partnership and take that times 12.4%, and that would be your Social Security tax. All right, you would do the same for your Medicare tax, but unlike Social Security, Medicare has no limit. Okay, so for example, Donald Smith, a sole proprietor, will pay Social Security tax up to a certain point, all right, and he will pay Medicare tax on all of his earnings. Donald Trump, the President of the United States, would also pay an unlimited amount of Medicare tax on his earnings, or any other person that you can think of. All right, there is no taxable wage limit for Medicare. All right, okay, it is simply 1.45% for the employee and 1.45% for the employer. All right, combined is 2.9%, and you pay both of them. So the combined rate for the FICA tax is 15.3%, 12.9 plus 12.4 plus the 2.9. All right. If you have a fairly good job during the year, and you lose that job and you get another job, another good paying job right away, you could have the situation that on page 911. All right, and this is if you overpay your Social Security taxes because you held more than one job, and the two jobs combined to go over the taxable wage base of $127,200. So let's go back and look at your Form 1040. All right, and take a look at line 71 of your Form 1040. All right, on line 71 is where you take the credit for any Social Security taxes paid on wages in excess of the $127,200 taxable wage base. All right. Okay, so that ends this video, and on the next one we'll talk about when employers have to deposit all these taxes that they're withholding from their employees.